Hello and welcome to MAA Budgets Part 2. Apologies for not using PowerPoint, but I'm going to try and do something differently. This would normally be a handout that I would give in the lecture. Obviously you will have a copy of that attached to this week. But I thought what I would do, and this was normally what would happen in the lecture, is I will talk you through it, because these are actual examples of how you put a budget together for a manufacturing organisation. So what would happen is that we would have a template that would be created by finance. We would have a master folder or a master file, and from there we would send out a budget to our managers, our budget template, and what we would do is we would present them with all kinds of numbers and cost centers and cost codes that they are involved with, and we would expect them to fill this out. Okay, so let me show you what we're trying to do. So what we've got here is that this is for my logistics department in a previous life, and so what I would do is I would send this out to the manager, and in there is a description of everywhere that we post our charges to. And all of these are all our account codes that you will get involved in. And this is why I said that financial accounting is not separate to management accounting. Financial accounting is you're presented with an invoice, and your purchase ledger clerks must, or even now it is automated, you must make sure that your automated system takes those invoices and posts it to the right cost center and account code. And so what we've got here is that what we've asked people to do is we've said, okay, please for this line present us with the forecast, and then we present a full year, and that's what actually happened against our forecast. So we've got a variance, and then what we've asked, what we will ask the manager to do, is in that blue column is fill in the totals that they think that they are going to have to pay for the whole year, and then it's spread across the year. Now what you'll see is that sometimes, because of, let's say, the freight in line, is because that freight in line is fairly consistent, then it's a nice easy 12-month split. What happens, and there should be more science to it, is that freight out line, as you can see, it's more sporadic in terms of how its cost is spread across the year, and that will be relation into the volumes that we expect in relation to sales leaving the factory. Now what you can see is that this is all based on some logic, and this is what I talk to you a lot about, is this idea of cause and effect, is there's always a check somewhere. Yeah, so December, for example, there's a very, very low freight charge, and you would expect that because of shutdown for the Christmas period, and therefore we're only really selling for 2.5 weeks to maybe 3 max, depending on the timetable and the dates. And so what then happens is, once you've done all that, filled it in, make sure that it double checks in terms of the amount you've entered there, matches that one there, and then you've got an OK, and then you've got a variance. Yeah, you've got a variance to forecast, and you've got a variance to your full year. And what you've got to do is you've got to hope you're getting better, but if not, if it's all those minuses, we've got to understand why. So let's move down a little bit more. So when we actually look at the overheads for distribution, we can see the salaries. Now that'll be all put together by another spreadsheet that will feed in, that will say how many people are working, how much they're paid, how much national insurance they pay, whether we have any pension contributions outstanding or agreed to as an employer, and we would build up the salary cost. And as you can see, is the number of people isn't changing, so we should expect a flat fee or charge for every month. Okay, but that wage bill has gone up an awful lot, so we need to think how many more people have we employed, and stuff like that. So there you go. That's how you would do it. You make sure that it all balances, it all checks, and that's what I would expect the managers to fill in with the junior accountants. You would go, probably in your first job as a graduate or even a placement student, you would go and you'd sit with your manager and you'd make sure you'd get next year's budget right, and it all checks and balances, and if you've got any variances, you know why. Okay, so I'm going to move down. Ignore the blank page, that's just been put in for me so that I can separate each one. What then we start to have then is that we start to have, once we've created our budget, we start to have, as you can see, it's all driven by spreadsheets, and that's where you're going to spend most of your life, in front of a computer, making sure your spreadsheets are correct. Is that what then you have is you have your comparison of actual versus budget. So again, what you've got in this case, this is factory labour. So your factory labour is again broken down into salaries, overtime, shift payments, any bonus, insurance, pension, staff training, etc, etc. Any contract labour. The contract labour is very, very low. Okay, and how that pans out in relation to should we have any more temporary labour in is, the good news is with this company is making everybody full time in a highly skilled job, is that our variances regarding material usage and efficiency are very, very good. So it again, cause and effect. It proves that having contract labour is not worth it for this company. Low contract labour, very, very good variances. So what you get is again each account code. So again, financial accounting, purchase ledger, making sure that everything's coded to the right place. We've got our actual results, so that's what we actually paid people against what we thought our budget was going to be. Well, we paid people something more. Now what that suggests is that we've taken on one more person. Okay, and what you can see against the previous year is that we've had a lot more people than the previous year. This was a successful company, a growing company, so you would expect that. But this is your problem, is your budget is at a point in time. So if you had a chance to change the budget, that variance would not be showing, because you would expect that person to have been planned and brought in. Then what you've got is on this end is year to date. So depending on when this is that is the result for the period or the month. So let's say for the month of February, that would be the result. And then what you've got is your year to date would be January plus February, would make your actuals for year to date. Same as if it was for June. So June it would be this actual here would be January, February, March, April, May, June, all added together. And then your budget would be, again, wherever you are at your point in time, that's all your budgets for the month added together, and then we'll see where we are. So what that suggests is that this person who we've employed has only started about a month and a half ago. So there you go line by line, and again, as a junior accountant ultimately would report to me as FD, is I would be very interested in understanding what this is and what that is. Now a very, very good junior accountant would tell me I was expecting that loss before it actually happened. That's where you earn your respect from me, is that you understand what's going to happen before it actually does. Because once we know we've got a problem, or maybe not a problem, we can spend a lot of time either justifying it or worrying about how we put it right, so that we've got an answer when we report these numbers. So again, that's all it is we're looking there purely at the salaries of people, and on this one we're looking at all the other overheads associated with production. So we're looking at things like security, we don't pay a lot on that, rent and rates, yeah, something a bit screwy there. So what we would need is, we mustn't have had the bill, so maybe we need an accrual, or we might have had a rebate. So I would be looking at that. I would expect you as an accountant to be looking at that. My electricity is higher than I expected, so again that's a bit of a concern. Could be that we had a colder month than we thought, but again you should be able to explain that before it happens. So that's basic actual versus budget performance management. So let's move down, and I'll just show you one other thing, is that what you saw just a minute ago was the actual detail, and that was called, when you go line by line, that's called horizontal analysis. Okay, now this, where you see all these percentages, is called vertical analysis, and now we're looking at the income statement consolidated, so all those small account codes are all rolled together so we can see how we're actually doing. And what you can see is that year to date against budget we're doing okay. Alright, so we're 17% up, but bizarre enough, although we're doing well in our domestic markets, that's sales to our UK people, is that sales to our sister companies across Europe were actually down about the same percentage. So where we've won in one case, we've lost in another. But obviously focusing on the domestic market has a better effect for us, so it's good news overall. So what you'll now see is, because of vertical analysis, this is what helps if you can't flex your budget. So if you put your sales at 100%, okay, what you can see is you can see your costs in relation to your sales. So if, like I said, if you can't flex your budgets, what you can do is you can see your costs in relation to those sales in proportion. So what you can see is that our wages are actually quite low in relation to our sales. Yeah, and can you see that? So we were budgeting to be about 9%, wages to be 9% of sales from what we sell. So we've only got a 4%, so that's really good news, a really big saving. So when we see a good saving, we celebrate that, but we're also very cautious. We don't trust it. We have to go and say, right, why is that the case? Let's look at materials. Materials, we were expecting 19.3%, and we've ended up by 16.1% of our cost of sales in relation to sales is materials. So what that says is, again, we've saved in materials, but again, cause and effect. How would we manage that? And the way that we would do it is we would look at our variances again. So have we got the equivalent savings showing in our usage and price variances? Okay, as you can see, let's look at the more stable things. So they are logistics, 3.8% versus 3.9%, so we've gone up slightly. So that says, despite the increase in volume, we've kept prices more or less the same, so that's good news. Possibly because of that volume, there might be a slight increase depending on where we're going to, so there might be additional costs there. But as you can see, everything's fairly flat. So despite the fact you've got all these negatives over here, is if you didn't do your vertical analysis, you'd go mad. And because we can't, or we don't have the resource in this particular case to do the flex budgeting, what we can see is that when you look, is that it's still in about the same proportion, so we're not really too worried. There are concerns, but not massively so. Okay, so where else is there? So everything else is all pretty much stable, as you can see, and we would do the odd investigation. So sales and marketing, again, it seems to make sense that we've gone up sort of 7% in sales. So, you know, we've gone up a couple of percent in our marketing costs. Although it seems a lot, is in proportion to sales, it's not the end of the world. So hopefully that's the last piece that you'll see. So what I've shown you is 3 pieces of paper. One that shows you how the budget works. Secondly is the budget from a horizontal junior management perspective. And then what would happen is I would share this with my directors. This shows us the overall, and then what we would do is we would obviously bury down to make sure that it's telling the tale that it is and the reasons why it is. So in terms of how we're doing is we're slightly down on what we expected, and so we will be trying our hardest to work through these percentages to work out what is we can either improve or reduce. Okay, so that's a whistle-stop tour of the type of things that you'll get in real life. I hope you've enjoyed it, and I'll see you soon. Take care. Bye-bye.